Welcome, welcome. So we've got a big report first thing in the morning tomorrow, a couple of big reports. Let's go ahead and hit both of these quickly and keep it nice and short for tonight. A few things to cover, not just a report, but we'll also touch on mortgages in just a moment. A little bit of housekeeping. It is coupon code expiration night, NVIDIA earnings day. We've talked about that for, I think, about 2.5 weeks or so. So that is today. For what that's worth, that's at meetkevin.com. With that out of the way, let's talk about projections. So after the Federal Reserve's, sort of minutes that came out today, we ended up coming down to just a 26.9% chance of actually getting a 25 basis point rate cut tomorrow. The minutes are available if you want totally for free in the Meet Kevin app, and you'll actually get the PDF highlighted with my highlights on it if you want. So if you really want to read the details, I think the most interesting part was where they talked about the potential for an AI crash potentially leading to a stock market pullback that could really hurt consumers and otherwise. That was probably the most interesting thing out of all of the minutes. Again, if you want to read all my highlights, just download the Meet Kevin app in the Apple or Android App Store and you get that for free. But outside of that, they do talk about valuations of equities being elevated, credit card delinquencies actually coming down a little bit, so peaking in September, though auto loan delinquencies ticking up a little bit, and payments in kind on these private credit loans actually increasing a little bit or remaining elevated. Not great. Those are companies who can't actually make their payments, right? And so they do say that while we don't actually see any kind of sharp decline yet in labor, there are obviously risks to the downside, including the risk of a sharper than expected weakening in the labor market. This is the same thing that we saw from Barkin. Remember, Barkin told us pretty clearly that, like, hey guys, everything looks good right now. I mean, unemployment claims haven't spiked. We know that he knows that we know that unemployment claims lag, okay? He's kind of like whispering to us. And he's like, hey guys, it's probably good that layoffs haven't spiked yet. You know, like that's how they talk to you because they don't want to cause panic in the market. And people who just hear like, yeah, that sounds good, man. Yeah, but we look at this and go like, got it. We hear you loud and clear. If layoffs tick up, you guys are going to slash rates really fast. I believe that will happen at some point. I don't know when, but we'll see. The labor report that we get tomorrow is going to be really interesting, though, because it's going to be the September jobs report. We have expectations for this release. We're not getting the October jobs report. That was obviously canceled. So this is kind of dated information, but the consensus here is that we're going to get a big number. So there's only one economist who thinks that we're going to get a negative 20,000 read. That is out of 68 qualified economists. We only have 61 estimates, though, so I guess maybe 7 of them are on vacation. The next lowest economist is sitting at 25,000. Let's see if I could actually just take a picture of this or a screenshot of this, and I'll beam it over. But anyway, in the meantime, that's good, okay? So we're probably going to get a beat tomorrow is the expectation. The average estimate is 55,000 and the median estimate is 51,000. So it doesn't actually look like we're going to get anything scary tomorrow. Then you've got, let's see, window, if I do this. Yep, there we go. Okay, perfect. Then on the high end, you actually have some estimates going as high as 100,000 on the jobs report tomorrow, which would be quite remarkable. I mean, that's all you need tomorrow to get back to a bull rally, and that's what I really wanted to talk about. To get like a really good bull rally going, if you had a good September jobs report, people aren't going to make the connection, I think, that well that, oh, well, October is so bad, they're hiding it. They're just going to go, oh, wow, cool. September, the jobs report is good. NVIDIA's good. Everything's booming. Yay. Now, we'll see, obviously. I think, this is going to come, well, we know this is going to come out at 5:30 a.m. in the morning. So this is going to come out before. Now, the prior release was 22. So I know that might be a little confusing why that says 22 right here. Here it says 55,000 as the average, 51,000 as the median. I know those are cut off. But you can kind of see the distribution over here. Man, I took a dumb screenshot. Anyway, I'll just show it to you. This right here is 50,000. The average is right here, middle of the bell curve, 55,000. And so look how fat it is over here. There's a lot. I mean, I know there's a lot concentrated in the middle over here, which is moving the average here, but you can see this distribution actually goes pretty wide to the outside on the right there. So it does skew quite a bit to the upside. So we should have a decent jobs report tomorrow. Okay, good. It's for September. What is that? It's bullish. In the alpha report on Monday and on Tuesday, what I said this week was that the most important catalyst this week would be the ADP report. I thought the ADP report would be the biggest risk that we would have a negative read. And in the alpha report Monday morning, I said, hey, if we get through that ADP report, expect positive out of NVIDIA and expect positive out of the September report. The setup is really positive for these. Now, NVIDIA obviously smashed. We know that. Is it possible for this jobs report to miss? Yeah, I mean, of course it's possible, but is it probable? Probably not. Like, I wouldn't wake up expecting this to miss heavily, mostly because if we actually look at the standard deviation, I'll pull that up. Okay, while I pull up the standard deviation, it's also worth noting that tomorrow we're going to get continuing claims expected to be 1950, so just shy of 2 million, and then continuing or initial claims at 227. The last read that we got on Tuesday, which was a catch-up read, wasn't that good. It was over 230. So you don't want to start seeing that come up because it means you're already in the second half of a recession, which we very well may be. But the second half of the recession is the part where the markets start pricing in recession. So you don't want that. You don't want to see those unemployment claims come up. So as far as the standard deviation, it's 21K. So you'd have to have a more than 2 standard deviation miss to get like a negative number here. Again, it's possible, probably not. So we should have bullish news tomorrow. The question is, will that bullishness on jobs just lead to lower rate cut expectations? And so far, as rate cut expectations come down, we actually often see the market come down. What's going to be resilient to this? I mean, probably the tech stack tomorrow, right? So, we'll talk about this in detail tomorrow, but we'll see, how the setup looks tomorrow, how pre-priced in some of this stuff is, how risk assets are moving, how some of our trend lines are looking. But CoreWeave's trying to pop off. CoreWeave's come down substantially here. This would be a great place for a bounce. Even if it's a dead cat bounce, NVIDIA could drive dead cat bounces at a lot of different stocks, whether it's CoreWeave or it's Palantir or it's Ethereum, which has been coming up really nicely off my 2875 line. I know people are going to look at this and go, bro, your line was seriously within $6 of it where it bottomed right there. And it's like, yeah. And the line's been there for a long time, but people aren't going to believe it. Except for the people who are in the courses. They're like, oh no. We know where Kevin's lines are. But anyway, you regain 92 over here on BTC. That you can kind of see you're already ceilinging out a little bit. You're kind of capping out a little bit. Consolidating is the more appropriate phraseology, right? Same thing over here. You've had your run so far in the nighttime. Not a lot of volume here. I think a lot's going to be predicated on, look, if we get a horrible jobs report, it gets sliced either way, right? If you got I doubt this. I really doubt this. But if you got a negative 50,000 jobs report or something stupid, yeah, that would be really bad. Okay? But I don't think you're going to get that. Instead, it's more likely that you actually get a hot jobs report and you get something that's 80,000 and people are like, oh my God, there's no recession. Even though the September numbers really aren't going to matter, it's going to help move that average up because our average payrolls on the BLS report in the prior 3 months were 29,000. So, 80,000 would be great for that 3-month average. It'll certainly move that 3-month average up really nicely. So anything over 30,000 is good. If it gets too hot, though, unfortunately, you're going to see those rate cut expectations come down. And then the problem is, do we just go back to where we've been the last few weeks, where the more we unprice those rate cuts, the more the market sells down? That's going to be evidenced by institutional selling tomorrow. Now, I don't know, because those NVIDIA earnings were very good. The NVIDIA earnings, honestly, they price in the potential for a $300 stock at some point. That's about a 50% gain from where we sit today, which is very nice. Now, whether that happens in some kind of euphoric rally and then there's some kind of crazy crash or we just never get that, who knows? But tomorrow at AM, we'll get the jobs reports. I would say bullish markets. So like bullish catalyst. Okay? Bullish catalyst is anything over 30,000. It starts getting bearish if you really get above 70,000 because it's just going to be ridiculous. At that point, you're going to have Trump going, see, and the Democrats ruined everything with their shutdown. We're doing just fine. And you're going to see no rate cut for December. Like, you'll just price it down to zero. That's going to create some issues. Treasury yields will go up. It'll hurt your real estate plays, which, speaking of which, we'll want to talk about some of these real estate plays as well. I mean, there's this interesting chart here from The Economist. Maybe we'll dive into it more tomorrow. But they talk about this huge mortgage market in America slowly dying. And frankly, if rates stay high, yeah, the mortgage market is dying. But this was a great chart for understanding how real estate debt fares today relative to 2008. Because a lot of people are like, oh my gosh, if we have a recession, it's going to be like 2008. No. Okay, if you studied anything about Dodd-Frank, if you know anything about the ability to repay, or if you've ever gotten a loan in the last 15 years, you understand that lending today is a lot more stringent than what it was in 2005, 6, and 7 when you had a fog and mirror and you could get a loan. Huge difference. So the thing that you want to watch is look at this. Debt as a percentage of GDP used to be like real estate debt used to be around 77%. And you can actually see it's fallen to about 45% now. Debt as a percentage of the value of real estate, like the actual properties, has fallen from a level of about 55% to about 27%. This is a collapse right here in the amount of debt on real estate. This is quite literally the exact opposite of what you're seeing in securitized private credit, which is probably where the biggest canary in the coal mine risks are, right? This is the exact opposite of private credit. Like, private credit is pretty much your 2008 over again, right? 2000, like private credit, faulty audits, faulty AAA plus ratings, and a lack of regulation, and really incentives for like pumping dumps, basically. Not pump and dumps, but like pumping trash, essentially, because they just end up slicing up garbage and they sell it to old people that don't know any better because they're money managers, and everything's fine. Well, it's fine because you get a high yield, and it's great for fixed income investors to get a yield on financing receivables or some garbage, right? That is '08 all over again. Now, we don't know what part of the cycle we are in for private credit. We don't know if we're here and we still got to go through this, or if we're here. We don't know that. So we don't know how bad the cockroach situation is. But the point is, the cockroach situation is not real estate debt. Now, you can make the argument that, yeah, but we've got oversupply in certain areas. Of course. Like, we know that. Texas, Florida, like, this is so old news. Like, how many more times are we going to say that, right? Those are problems. But those are oversupply issues. And you don't have those issues in other parts of the country, like where, frankly, mostly where House Hack has been buying, which is great. Knock on wood. We're very grateful for that. That said, this private credit issue, it's a big problem. It's not going to, I think, make much of a difference until there's a huge collapse that comes out of nowhere. That's why it's called a black swan, right? Some big bank goes under, and then all of a sudden credit lines get frozen or whatever. So really, we should have a pretty clean path. In the Alpha report, what was it, yesterday? We were looking at call options for I think it was 607? I think it was 607 on the Qs for Friday. And right now, the Qs are looking at 610. So, and we were buying those when the Qs were at 594. So, that's because after we got through the ADP data, we're like, well, should have two bullish catalysts coming up. Now, I don't have time to sit around all day long because I end up having to go to houses to watch options. So I trade options less than I used to because, I'm dealing with so much real estate. But the setups are still there. We still do that. That's why I like doing the Alpha report in the morning. So it's like, hey, here's the setup. Here's what I'm looking at. Here's what I'd be doing. And remember, you can always be a part of that by joining once over at meetkevin.com, and you get lifetime access to the Alpha Report. So that, I mean, like, broadly, I'm not bearish on the jobs report. I'm not bearish on NVIDIA. This is very good. I'm worried about layoffs and private credit, but that's it. And so on the bear bull scale, because people regularly ask me about this, and I've been pretty consistent, you can actually see we update this pretty regularly on the in the courses. So when we do our Alpha Report in the morning, I don't do this every day. Maybe, I mean, it doesn't honestly, I think, make a difference to do it every day. But anyway, my bear bull scale has been pretty consistent in the like 4.9 to 5, mid-5s range, especially with the ADP numbers that we had gotten in October. That definitely pumped it up a little bit. So right now, I'd probably have us at, and this is going to be predicated on, well, this is not predicated on tomorrow's job data. We'll update it tomorrow on the jobs data. But I'm probably 5.5, so it leans slightly more bullish. Still at risk of layoff spike and the unemployment bleed, private credit risks, and some form of shock, right? Which could be also AI slowdown, debt risks, etc. But that risk is not in housing debt. That's very clear here. A fraction of the housing debt today compared to GDP and household values versus 2008. So that's really not an issue. And then I do think that the Fed not cutting does risk a policy mistake. So that will lead them to cut more rapidly when that pain becomes more evident. That could be in a month, it could be in 3 months, it could be in 6 months, we don't know. When that time comes, once we start thinking like, oh, the Fed's about to, cut really heavily, I mean, we'll know, we'll see it. But in the meantime, this gives us a setup of what to expect as we go into tomorrow. Hopefully institutions don't dump on us. There is a real possibility, though, that you're going to get a bunch of profit taking, and you're just going to end up repeating this curve right now, because there's a lot of risk management going on in markets right now, and you could get a little bit of a bounce right here on the 595 line, which is basically what we're bouncing off of here. And you get a little bounce just like we had on the 617 line, and then guess what? That just goes right back into selling. I don't actually think us not getting the October jobs data is a good thing. I think it's a bad thing. So I don't like that. And that to me just increases the risk of a policy mistake. Worth noting. So yeah. Somebody here writes, Google's strong. Dude, Gemini's sick. Google's great. Google will come down in a recession, but not right now. Let's see here. What is this? Look at NVIDIA numbers. Did you see my video on the NVIDIA numbers? We had to blur some of my video because the numbers were so good, because I was worried I was going to get in trouble for showing this massive
big PP
on my, stream. And that's scary. You have to be very, very careful there. Anywho, so yeah, Meet Kevin code expires tonight. If you have any questions, you're always welcome to email us over at staff@meetkevin.com.
Email staff@meetkevin.com.
And with that said, we'll see you tomorrow morning. Goodbye and good luck.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.